Good morning, everyone. Welcome to With the Brokers live daily market outlook for Tuesday, 2nd of October 2012. I apologize for a small delay due to some technical problems. We are starting our session now. I see that a number of you already gathered, and there's still some expected to come. So just an introduction to mention important events that happened during the night as Australian Central Bank cut rates despite some expectations to stay at 3.5%. They drop it to 3.25%. I do apologize, cutting by quarter point. A slowdown in China and the falling export prices, as well as high currency, all deemed the economic outlook in Australia. So the central bank has been forced to act. The US dollar's immediate reaction fell to the levels of approximately slightly below 103 after the rate cut was announced, and yet action to be seen as most of analysts still see November as the more likely window for a further cut of the interest rates. The board of Bank of Australia judged that on the back of international developments, the growth outlook for the next year looked a little weaker. Reserve Bank of Australia Governor Glenn Stevens said after the central bank's monthly policy meeting, and the board therefore decided that it was appropriate for the stance of monetary policy to be a little more accommodative. The latest move brings the cuts delivered since last November to 150 basis points, and investors had priced in about 60% probability on an easing this week. As I said, there were some forecasts to stay at 3.5, but also some of them were pointing for the rate cut. As said, immediate reaction, the Aussie dollar against US dollar fell down to 103 zone. The other problem, the biggest problem basically of Europe is the Spain. It's ready for the bailout, although the Germany still, as main paymaster of Europe, still signals to wait. The Spain is ready to request Eurozone a bailout for its public finances as early as next weekend, but Germany has signaled that it should hold off, according to the comments of European officials released yesterday. The latest twist in the Eurozone's 3-year-old sovereign debt crisis comes as financial markets and some other European partners are pressuring Madrid to seek a rescue program that would trigger European Central Bank buying off its bonds. The German Finance Minister Wolfgang Schäuble said Spain is taking all the right steps to overcome its fiscal problems and does not need a bailout, arguing that investors will recognize and reward the Spanish reforms in due course. Privately, several European diplomats and a senior German source said that Chancellor Angela Merkel preferred to avoid putting more individual bailouts for distressed Eurozone countries to her increasingly reluctant parliaments. So we will now see what the final verdict will be for Spain, whether to ask and get the bailout or to stay according to the German suggestions without and do it on their own. As a result of yesterday's quite positive, surprisingly positive PMIs from Europe, UK and the US, reaction of the market was quite positive as euro was pushed above 129 barrier following last Friday's fall to 128. Strong psychological support that so far holds the downside, but still the downside, according to the technicals, still remains quite vulnerable, as the pair is so far unable to regain a break point at 129.70, and most likely the gains will stay limited under this level, and another psychological at 130. as the pair starts the European session, and there was moving during the overnight session steady around the 129 handle. From the other side, sterling is still under pressure after hitting 161 low yesterday, as brief recovery action still stays below 162 level, and currently is in rather sideways. Near-term movements are in sideways mode, and the downside still pressured with immediate support at 161. Also trendline support, seeing more risk towards the downside. We have a question. We're going to answer the questions at the end, if you don't mind, because usually at the end of my presentation you come with your questions, and I have the question already placed. So if you don't mind, I will answer it at the end of the session. As said, sterling is still under pressure. The dollar yen holds its near-term positive tone after bouncing from 77.42, but still showing no significant signs of further extension, despite some fresh strength that posted marginally fresh high at 78.14. It's still seen quite pressured, as larger picture remains negative. Dollar Swiss also losing traction following a brief break above important 94 zone, with 93.70 zone, the support zone, now coming under pressure as a reversal of 94.36, yesterday's high, still keeps the downside pressure. Surprisingly, yesterday's a strong rally on commodities brought the gold to the fresh yearly high at 1791.10, as the yellow metal holds steady around 1775 during the Asian and the morning session, following yesterday's spike higher and a quick reversal down to the levels of 1770.80, where it currently stands. But overall positive tone now sees more potential towards the upside, yet no confirmation of firm break higher that is required to confirm breakout of past 2 weeks range. Silver was also significantly higher, as it hit fresh high at 35.36 versus the previous high at 35.17, and currently holding slightly below 35, holding still steady. Crude oil also recovered, extended its near-term recovery of 88.94, with the yesterday spike up to 93.31, now seeing more potential for the recovery. Yet we need to see a gain of 93.80, 94 in order to confirm the near-term base at 88.94. More of this, of course, will come in our technical part. We're going to take a quick look at the today's calendar and see the events that are due or already being released. As said, the Central Bank of Australia released their new cash rates at 3.25. Nationwide home price index from UK that was released at 6 o'clock GMT came in disappointing, minus 0.4% compared to plus 0.1. I do apologize. Forecast, and 1.1% of the previous month. Australian commodities prices came lower than the previous release at minus 14.9% versus minus 14.7%. Spanish unemployment change came at 79.6 thousand compared to 38.2 thousand in the previous week. Another to come is construction PMI from UK due at 8:30 GMT. Eurozone, which is basically forecasted at 50.1 compared to 49 of the previous release, and the Eurozone producer price index for August is forecasted slightly better than previous 0.4 release at 0.6%. UK, and basically that will be all. Let me just take a look, because we still have some technical problems. Basically that will be all from today's releases, as the other releases are already falling in the next day according to our local time, so we will be talking about them tomorrow. Now let's take a look at our charts and see the latest movements and the forecasts for today for the major currencies and commodities. As always, we start with the euro. First, to take a look at Ichimoku studies, this chart came first. As we can see, the euro is still steady in the downtrend of 131.70. Double top has series of lower highs, and the lower lows keep the near-term downtrend in play, and maintain the downtrend. So far, 128 psychological level held the downside. We have the 200 days moving average at this point, and just above it at 128, currently 128.50 is the trend line support. Break of 128 would be quite risky for the single currency, as the daily studies are aligned towards the downside and the descending mode, losing also the momentum, and as said, more pressure seen towards the downside in the near term. Near-term price action has so far been limited at 129.37. This was yesterday's high, short of important 129.70 barrier that is required basically to confirm the higher low, to confirm, pardon, bottom at 128, and allow for stronger retracement of the current corrective action of 131.70. Failure to break these levels, of course, would be signal of fresh weakness, as two repeated attempts higher failed, one at 129.58 and the other one at 129.37. This is also counting the lower highs that still sees the downside quite vulnerable. Near-term price action is now entrenched within the narrow range of 128.75 and 129.37, with the failure to break above the triangle resistance this morning at 129 now sees more pressure towards downside, as the price already slid below the triangle support. The immediate risk will be seen on the loss of 128.75. This is yesterday's low, and the current consolidation floor, that break of which of course would further weaken the structure and keep the upside levels intact for possible fresh slide down towards important supports. 200 days moving average currently at 128.21, and the low, yesterday's low at 128. That loss of which will be quite bearish for the pair, and of course will be signaling a further extension lower, with the 127.39 that marks 38.2% Fibonacci retracement of the larger up move from 120.42 to 131.70 to be seen as the next target. Also, we have the channel support at this level. So next quite strong support comes at 127.40 in case of a break below 128. Conversely, we need to see again above of levels at 129.70 in order to ease the current bear pressure and reattract the next psychological barrier at 130.00. That, according to the near-term studies, looks still unlikely, despite hourlies are still rather positive, but in descending mode, while 4-hour chart indicators are well in the negative territory, and see the downside more vulnerable at this point. And the sterling, as said in the introduction, holds remains under pressure as a sharp reversal of 162.71. This is the last Friday's upside rejection as the third attempt towards 163 zone. The second unsuccessful. You had the first failure at 162.66 and the next one at 162.71, triggering a sharp fall that was so far contained at 161 zone. This was a low of yesterday, of course, triggering more pressure towards the downside, with hourly studies improving, pointing higher, but not yet confirmed, as the price action remains under the bear trend line drawn of 163.08 through highs at 162.60. Still keeps, with yesterday's forced break higher, still keeps the downside, the upside limited, as well as moving averages at this point 61.77. So this is our initial barrier at the upside. Further up, regain of 162.00 as a psychological resistance, and also the 4-hour chart, Ichimoku cloud base will be seen as a more positive signal for possible further recovery. So far, more focus seen towards the downside as the downtrend of near-term downtrend of 163.08 remains in play, with the loss of 161 recent base and also the trend line support. And also marking the 38.2% retracement of the up move from 157.69 to 163.08, seen as a trigger for a further retracement. On the downside, in case of break, we have 160.74 low of 13th of September, and then 160.33 7th of September high, and 160.39 50% retracement seen as the next downside target. Currently, congestion break either side of the current congestion will basically define the near-term direction, but I need to point that weak near-term studies still keep the downside more vulnerable at this point, and unless we see a gain of 161.70 and 162.00, more likely scenario would be fresh attack down towards 161.00. And the dollar yen, pardon, as said, it maintains its near-term recovery of 77.42 last Friday's low, with marginally fresh high posted this morning early hours of today at 78.14 against 78.10 yesterday's high, but still lack of momentum and lack of strength seen is evident at this point, as the pair fails to extend its current recovery. 38.2% retracement of the latest down leg from 79.21 to 77.42 so far keeps the upside limited, although the 4-hour chart indicators are now in the positive territory, and price moved above both moving averages. Still we are seeing not enough strength for a possible stronger push higher, and the test of next important barriers at 78.31.53 that mark 50 and 61.8% retracement, and basically above 78.50 is to relax the downside for a while, and probably to turn focus towards our key barriers on the upside, 79.00 and 79.21 recent peak, as well as 79.30 exactly, where is the 200 days moving average. Basically 79.30 is a very strong resistance zone, and only break above this level, these levels could be trigger, is seen as a basically trigger for a stronger recovery. Otherwise, the downside will remain more focused at this point. Initially, we have the 55 days moving average at 78.41 and the 90 days one at 78.76. So quite strong resistance zone between the 78.30 and 78.80, and the break of these obstacles is required to refocus upside levels. Alternative scenario, of course, is the fresh slide and the loss of 77.42 recent high, recent low, to open 77.12 low of 13th of September, and 77.00 psychological and round figure support. And the dollar Swiss is still struggling to hold the gains following a recent break above 94.00 that marks 200 days moving average, as a brief break occurred up to 94.36, but a quick reversal down to the levels below 94. So far found support at 93.51. I need to mention that near-term uptrend is still intact, as the trend line that defines the trend is still holds the downside, and series of higher lows keep the uptrend intact. But current yesterday's actually upside rejection at 94.36 and subsequent slide lower, with a brief recovery attempt being limited at approximately 93.90, just under 94.00, and being limited by 55 days exponential moving average on the hourly chart. Still sees more pressure towards the downside. Hourly indicators are in the negative territory, holding below their midlines, with the descending, I would say at this point, neutral to negative 4-hour chart indicators, as the price remains entrenched between 55 and 10 and 20 days moving averages. Only break above 94 would revive current bulls and refocus upside levels 94.36 and 94.47. That marks I do apologize, 94.47, that marks a 61.8% retracement of the down leg from 95.77 to 92.37. Otherwise, loss of trendline support at 93, currently 93.58, and lows at 93.50 and 93.26 could be quite bearish, especially the loss of the later one that marks also the near-term double bottom would be quite bearish, and would keep the upside aside for now in favor of further weakness. And the said yellow metal appreciated yesterday on the sharp move, posting fresh yearly high at 1791.10 with subsequent a quick reversal down to 1770.80 zone, but still keeping the positive tone and attempting to clear to break above the recent range of started at 14th of September 2012. A more focus has seen at towards the upside at this point, as near-term studies remain positive, and as we can see on the 4-hour chart, this price action is still holding above 20 and the 55 days moving averages. That keeps the upside in focus with a clear break above 1790, 1791 required to turn focus towards our next important levels at 1800 and 1802. This is the high of November 2011, and the possibility to refocus all-time high at 1920 posted in September 2011. Many analysts agree that probability of further extension higher and a possible rally towards psychological $2,000 per ounce price is quite likely and quite realistic at this point. We will stick now to our technicals and see that upside remains focused in the near-term action with immediate support at approximately 1770 zone and 1763 on the hourly chart. Fibonacci, this is 1763 marks exactly 50%, while the previous one is 38.2% retracement. I would say at this point break below 1757, that is 61.8% retracement, will signal a possible fresh weakness, and this is also the previous range floor that was extended on the spike to 1736 last week. That could be quite bearish and weakening the near-term tone. On the upside, I said the regain of 1790.91 is to open 1800 as the next target. And finally, the crude oil remains in the near-term corrective mode of 88.94 with quite strong outlook seen at the near term with the 93.31 seen so far. This is the first barrier, 93.17, that has been regained. Still need to see the break above 93.82 previous high and 94.00, approximately 38.2% retracement, and basically the previous range, consolidative range floor that is required to signal near-term bottom at 88.94 and turn the focus higher. Hourly price action remains now congested between 93.30 and the 90 and 125. This is the current range, but break above bear trend line drawn of 93.82, connecting 93.82 and 93.17, and now signals more action higher. Immediate support is at 92 zone, which is the low of today, along with the 55 days exponential moving average ahead of 91.25, and basically only break below this level would delay the current bulls, as this also marks a near 50% retracement of the latest up leg from 88 to 94 to 93 31. As said, near-term structure is still positive and having positive elements with the break above yesterday's high at 93.31 and more significant 93.80, 94.00 required to confirm the bottom at 88.94 and open way for stronger recovery. Any failure at these points could still keep the downside vulnerable for possible fresh extension lower, as the near-term downtrend for now of 100.72, this is 14th of September high, remains intact for now, and basically break above these important levels is seen required for a fresh recovery. On the daily, the negative tone continues to dominate as 55 days moving average still keeps the upside protected. Basically, the price is moving between 90 and 55 days moving averages, with the significant barrier set at 94.00 and the 200 days moving average currently at 96.28. As studies and indicators on the daily chart are still in the negative territory, still seeing more potential towards the downside unless we see a break above previously mentioned 94 barrier that will allow for some stronger recovery. That was all for today from me. Now we have questions. We have already one. The question about okay, the first one is about Chinese quantitative easing. I have to admit that I didn't pay too much attention to this, more focused to the Europe. Cannot elaborate much more on this, but let's leave this question. Let me see some articles and text that I have to prepare myself a bit more for this, and we can discuss it on tomorrow's session. The indicators that I use on the chart, this is our standard settings. It's a template. If you want, I can send you. Most of our attendees have this template as they required, and they asked me to send it, so I provided them. Basically, what we have now, it's first of all, it's separated by the time frames. On the hourly chart and the 4-hour, they're quite similar settings. We have RSI 14 days MACD, 14 days momentum, and the stochastic. Also the 10, 20, and the 55. 1 second, I am not showing you the screen. Okay, let it just come. Okay, so basically on the hourly chart, we have RSI of 14 days MACD, momentum 14 days, and the stochastic as standard ones. So with the moving averages, blue one is 10 days, red one is 20 days, and the green one is 55 days one. And similar configuration is on the 4-hour chart, where momentum is 22 days, and then we have momentum against the moving average of 7 days, momentum 14 against 7 days moving average, while on daily it's 55 days is the pink moving average, 90 days is the blue one, and the red one is 200 days moving average. The other indicators are standard. Also, I use the Ichimoku studies. I don't know how familiar you are with this. If you want, you can send me an email on analysis@windsorbrokersltd.com. Let me just put you the screen so you can see it. Okay, here you have the email. Send me just empty email to have your address, and then I will forward you today template, so you can use. Most of our attendees found it very handy and very useful to have the same settings, so we can follow up, watch the same picture. Sometimes if you have even different color of the chart, it doesn't look the same. when you follow something, and most of the people that requested this said that it's quite easier for them to handle it this way, as they have also their own charts in front of them during the presentation, and they see, spot, and recognize all the points that I mentioned. So if you don't mind, just send me email on analysis@windsorbrokersltd.com, and I will provide you with the templates for a short and a longer term. Is there any other question, please? No. Okay. In case, yeah, we don't have further questions. Okay, I would like then to thank you all for being with us today, and of course expect you tomorrow at our standard time at 7 o'clock GMT, 10 o'clock local Cyprus time with the news and the new events and analysis that will be on the table for tomorrow. Until tomorrow, I wish you a nice day and very successful and profitable trading. Good luck.